Module 6, one or two parts of the tax section. Taxes is such a big, important part of our world. It is one of the sides of the triangle, which is investing on alternative investments. Secondly, is taxes, where you get a lot of passive losses to unlock a lot of these different strategies. And then, of course, infinite banking. This is why we'll dedicate a couple sections of this masterclass to taxes in particular, differentiate between tax tips and overall tax strategy. So what I have displayed on the screen are, I call a lot of these types of tactics small ball tax moves. Yeah, it's cool. And I think a lot of people, especially when they come to the retreat and late into the evenings, they like to talk about these types of strategies that are employed, but it doesn't move the needle as much as what we're going to be talking about, driving down your adjusted gross income with passive losses or maybe doing real estate professional status. But just to whet your appetite here, some of these things that people will do, use qualified retirement plans, self-directed IRAs, solo 401ks, gain harvesting, wash sale rules, paying off your cell phone or your power bills a year earlier to capture those losses, paying your kids, which is essentially just a cool way of income shifting from your high income to their lower income. You're going to need a LLC for that. And then general business deductions. Now that you have an investment business or you have a small business, pushing as much expenses over to that side of the business as opposed to your personal so you can get a tax deduction on it, essentially recovering maybe anywhere from like 15 to 45 cents on every dollar that you spend. And number 6 here for other business owners, if you utilize the S Corp, you can optimize a salary dividend split to minimize the self-employment taxes and miscellaneous taxes that you can get around with that S Corp strategy. But again, these are all really miscellaneous types of tax strategies out there. But we're going to be focusing here on is the big overarching one. And the way I always explain it is like if you're trying to fill an aquarium, you fill it with the rocks and the sand. Think of these things as the small sand particles. And what we're going to be getting into is more of the rocks. So just going into my story, before I got into real estate and I was just a working Joe, I had no passive income, and 100% of my income was coming from traditional investments and ordinary income. And I was getting killed with tax doing this. Fast forward a few years when I was starting to buy rental properties in 2009 and to 2015, I did turnkey rentals as I was a non-accredited investor back then. It was becoming where maybe half of my income or a fraction of it was becoming more passive income. And my traditional investments, my portfolio was becoming less and less, and my alternative investment portfolio was getting higher. Fast forward to several years later when I got 100% into syndications and private placements. Most of my income was passive, and especially as I left my day job as an engineer. And then 0% was traditional investments. Now, these are just 3 data points as a threshold to think about the phases. And as I have it in my book, The Wealth Elevator, which all of you guys can get a copy. And if you haven't got the audiobook or the PDF version to share with some of your friends, let me know and we'll get you that private link. I mentioned traditional versus alternative investments. What is that? Real roughly, in case you forgot. Traditional investments are here on the left side. These are the darker items where these are your traditional stuff, your public equity, stocks, bonds, mutual funds, or another way you can think of it as paper assets. On the other side is alternative investments, such as private equity and real estate. Now, this is a chart from a group called Tiger 21. To get into this group, you need to have a portfolio size of $20 million of investable assets. I wouldn't say these are quite family office type of size people. Usually family office is 100 plus million, but definitely I think the next level up from where our group is at with people in the 20 to 100 plus $1 million net worth size. But when they polled their audience, and this doesn't really change too much from year to year, this is what their portfolio allocation looks like. Now, it may not apply to us directly, but what I wanted to show was a data point and a glimpse into what the ultra high net worth are doing out there. But for purposes of our tax talk today, traditional investments are going to be typically giving you no passive activity losses and little, if not any, tax benefits. Whereas alternative investments, especially real estate, you've got a lot of losses and depreciation there. And in private equity is essentially you're investing in operating businesses and you've got equity in it. So a lot of times you can get some of the operational losses from those types of investments. But again, you can't be investing through any type of like REIT or fund. You've got to be more directly aligned with the operating group. And I mentioned it in previous modules, but that's one of the big themes here is to get past traditional investments where you're getting past the Wall Street fee structures and bloat, and you're getting closer to where the action is. This allows you to capture more of the returns by shedding most of the middleman, which is what makes up today's investment and financial world. Shown in a different way, this is a depiction of folks that are on the left side. I would say these are like regular Joes. You see the principal residents making up the majority of their net worth. And then they got pensions because these are higher net worth people. You probably wouldn't agree with it being under $500,000 net worth. But most people with any sort of net worth these days are going to be our older generation, people above their 40s and 50s. And a lot of those guys still have pensions. So you're probably wondering, where does my pension? Yeah, you don't got them. If you're under the age of 50 to 60, you probably don't have these types of things. But what I wanted to show was this middle category here where we're net worth between 500,000 to 100 million. And that is pretty much our community here, right? We're that layer underneath where the Tiger 21 folks are at on the right side, where if you take the pie chart from the last slide, it aligns directly over and validates this bar graph here, where they're buying half of their net worth is in businesses and other real estate equity right here, private equity and real estate. Now, stocks, bonds, mutual funds, the traditional investments still there at a third, but they also have some miscellaneous assets. And that's a lot of times we just don't know what that is. So what I would probably say, it's probably just more business and equity and stocks, bonds, mutual funds spread apart. But you can see how it is vastly different than the average Joe. $1 to $10 million net worth is this right here in the middle, where if you're looking at this for a lot of folks getting started, this might be something to emulate or move towards. But a good portion, about a quarter of their net worth is in businesses and other real estate. They've got another quarter or so in stocks, bonds, and mutual funds. They've got a chunk of it in their principal residence, where you can see the majority of the lower net worth guys are in their principal residence. As I always say, like the people that you don't want to emulate, like our parents' generation, who, yeah, they might have a net worth of $1 million or greater. Obviously, they have their paid off houses, which they aspired to, which we talked about is maybe not the best thing, especially when you're under a few $1 million net worth. But most of their net worth is under that primary residence. The one thing I'll mention here, if you're saying that for these high net worth people around, let's call it a $20 million net worth, just to put a number out there, very well maybe a $100 million net worth. This chart is saying that a little under 10% of their net worth is their primary residence. So if you got a $20 million net worth, $2 million residence. So that kind of makes sense, right? These are percentages off their net worth. But from a dollar wise, at only like 10%, this person obviously has more because their net worth is greater. I think you guys are smarter enough to understand the point I'm trying to make here. It's all percentages based off of the whole. Again, a lot of the stuff that I've talked about in these master classes are my own experiences. I'm not a tax attorney. I'm not giving any financial advice. I'm not a lawyer. But a lot of these things are steps that I went through personally. I started to buy rental properties 2009, so I had a lot of these tax benefits, but it really wasn't juiced until I started to get into syndications and private placements because of the bonus depreciation. And even if you don't have bonus depreciation, a lot more aggressive depreciation schedules when you get into bigger commercial properties, But this is my actual for my taxes in 2018, and this is I think maybe about a couple years after I've been in this syndication game that I paid about a 4.2% my first year in terms of taxes. Paid about 5-6 grand out of my adjusted gross income of 136,000. And then look what happened next year, 2019. This is when I think a lot of the passive losses got put in my schedule, paid no taxes, and I was able to drive down my adjusted gross income to $25,000. And this is again going back to the previous slide where this was the transition where I sucked my ordinary income down and it was just all passive at that time. So that's what was going there. This is where I think everybody wants to get to this clean energy burning mode where you don't make too much and you pay little to no taxes legally. And it's just very efficient from a tax perspective. So, how do you do this? So, I'm going to start off, might be a little slow for some of you who've heard this before, but I just don't want to leave anybody behind. Calling this Tax 201. Because if this is new to you, it's probably going to take you a few times to truly understand this. It took me a couple of years to really get it, but it's something that most people aren't even aware of nor talk about. So here on the left side, we have ordinary income. This is coming from jobs, W-2s, or if you own your own business, 1099s. This is all the active income. But let's call these things what they are from a tax perspective or in the tax code, and we'll call it ordinary income. So the bad thing about ordinary income is that you get hit with these high taxes and extra taxes like Social Security, etc. What we want more of is on the right side, which is the passive income. So passive income, other than the fact that it sounds cool and everybody wants passive income, but from a tax perspective, again, we're going to focus on this. Passive income comes from sources such as rents or syndications as a passive investor. And what's cool about this is you can zero out your passive income by passive losses slash depreciation from real estate. Again, if you have ordinary income, there's nothing really to shelter that or lower it down, right? What we're trying to do is lower your adjusted gross income, which is your ordinary income plus your passive income minus passive losses. Then the passive income is a better color of money. Think of these as different colors of money. Passive income is no different dollar wise than ordinary income, but you can offset it with passive losses. So the next obvious question, where do passive activity losses come from? And we'll call these things pals because they're our friend. If you look at the image here, the house is circled in red. This is the improvement value of this piece of property. The green part, the land, is not depreciable. For a general rule of thumb, just for conversation's sake as we move forward, in secondary and tertiary markets, a lot of the places that we'll invest in, not places like California, Seattle, Hawaii, which are primary markets, in these secondary tertiary markets that we like to invest in, about 30% of the market value of the property is going to be the green part, where in private markets flip-flop because the land is more expensive. The basic rules for residential real estate, if I use my first property I bought in Seattle in 2009, is that property was about $360,000. So if we break it down, and that was a primary market, about a couple $100,000 was the improvement portion in the red. So with depreciation in the tax code, it allows business owners or real estate owners to take a paper loss on their assets because the assumption is that these assets, or what's circled in red, the improvement portion, slowly decays in serviceable life. The house may last 100 years, but what's important here is what does the IRS tax code allow and what they say you can take as a paper loss. What they are saying for residential real estate is over 27 years, you can deduct the improvement portion over 27 years. Basic math here obviously gets a little bit more complicated on the taxes, which the computers do and the CPAs do. But just for our understanding here, 200,000 divided by 27 comes out to be about $7,400 per year that I could use as a paper loss on that my first rental property. Which on that rental property, if I think back then, I think I was making My rents were about 2,200 and there's obviously expenses. Let's just say I was making $1,000 a month of income after expenses and multiply that by 12,000 dollars per year. That would be what would come down on my taxes as passive income. But what I'm allowed to do is take the passive losses and also deduct that. So I essentially shielded $7,400 of income per year. And that certainly offsets a lot of that passive income. Now, 27 years is a long time. And it's helpful, right? As you can see in the last example. Funny thing happened to me when I started to go into syndication deals. I started to realize that in these commercial properties, the depreciation schedules are a lot more faster than 27 years in residential single family homes. And also, you can get what's called bonus depreciation, which basically what you do or what your general partners do, you don't have to do anything as a passive investor, is they'll get a cost segregation. This is what we do on select assets. And what this cost segregation does, it usually costs about $5,000 to do. And it's this big like report that is passed on to the CPAs. This report basically breaks down all the components of the property into these different categories, such as the 27 and a half year, the 15 year, the 5 to 7 year. And depending what the bonus depreciation laws are at the time, like in 2016 to 2026, I think it phases out. I think it'll probably get extended again. They're saying that you can take pretty much all of the 5 to 7 year and a good portion of the 15 year all in the first year, which really front loads a lot of this depreciation. And this is why bigger deals are better because you can get a lot of these losses quicker. Now, we'll get into some of the specifics, but it's better to get a deduction sooner rather than later because of time value of money. Because if you're able to maximize the usage of those losses now, you can save money on taxes and then you can have more money to invest, right? That's the kind of general idea, time value of money. I just put a screenshot here of one of my K1s, which you get as a passive investor. This investment, I put in $50,000 and I got a negative $36,000, almost $37,000 first year loss on what I put in there. So almost, I would say 70 to 80% of what I put in, I got a loss to be able to offset obviously the income in this project, but also could be used to offset other parts of my passive income portfolio. So here are some other examples. And of course, these things range and it depends a lot on how much improvement plan, how much leverage you're using. These are obviously from past years. Bonus depreciation comes and goes, but it's just a portion of it. Even without bonus depreciation, when you invest in these larger deals, these commercial assets, the depreciation schedules are a lot more aggressive than the 27-year standard straight line depreciation with your single family home. One of these, like $180,000 investment I made, I got $176,000 first year passive loss. So I don't know if I made any money that first year because usually the first years are usually pretty slow, especially in value add plans. But I was able to take that and pool it in my other passive losses to use elsewhere. Not going to get into the nitty gritty here, but this is a visual of what's going on in these cost segregation studies. Again, the general rule of thumb is you can take about a third of the entire asset's depreciation schedule in the first year. And then the rest trickles out in the next 5 to 10 years, is the way of thinking about it. If you guys are ever looking at a deal that we're doing and you wanted to really understand this, I can take some time and go through the estimated cost segregation. Because what we'll do is when we go into a deal, we'll typically get the cost segregation consultants on board, and they can usually give us a pretty good, you can run it through their software. Of course, it's always estimate. We don't know how it's actually going to become out, but for the most part, pretty close in terms of estimates. And the idea is you should be investing into multiple deals and then pooling your passive losses from multiple areas. And you always want to underestimate these things just to be conservative in your entire investment portfolio. And then this is just an example. Of course, all investments are different, but this was, and it all depends on the business plan too. And sometimes the age of the property. So this was a little bit of an older 1970s asset in Texas. made a $200,000 investment here in 2018. The 2018 K1 came out to be about 75 cents on the dollar or $153,000 of losses that first year. Again, that's where you get the majority of it, about a third of all the juice to squeeze. And then the rest trickles out in the coming years. So in 2019, got about 27,000, and then in 2020 got $11,000 of losses. But in this year, we actually exited early this deal, more than doubled our money in, I think, 2.5 to 3 years. Obviously, surpassed the business plan here. But at that point, when we exited, we had to recapture these losses. That's the other flip side of this. And we'll get into more of this in the next module. We'll review it again. But when you get these losses, you have to recapture the depreciation at the exit. But again, a lot of this is playing this game of time value of money, right? If I can get a $153,000 loss today, obviously offset all the passive income I made from this particular investment, maybe I can offset another capital gain from another deal that I'm in globally in my portfolio. That this $153,000 loss at the 45 to 50 cents on the dollar, especially if you live in California, because it's actually another layer of taxes there, you might be able to translate this into a $75,000 cash in your pocket at the end of the tax year. Again, you're going to have to recapture this when the deal goes full cycle. But if you're able to take that 75 grand, put it into the next deal, then you get even more passive losses to offset that and replenish your passive loss reservoir. But were able to have that money grow. And then when the deal finally exited, this one exited early, of course, right? A few years later, you have to recapture those losses. Again, this is new to a lot of folks. So don't feel bad if it just goes over your head. We're going to go over it a couple more times in a little bit different ways. I think once you get this and you talk to other people in our community, that's why we say come to the events, the retreats. And especially if you're going to invest more than $250,000, joining our family office Ohana Mastermind is, I think, a no-brainer. More so for the social relationships and connections there, and also avoiding stepping on a landmine, working with the wrong person out there in the world. But you'll get into conversations about people having fun with this stuff, strategizing, getting passive losses. When do they use it? When do they not use it? It becomes a little bit of a game. And this is where you need to self-direct your own tax strategy. This is not your CPA's job. Your CPA's job is to just do your taxes on your sheets. You can't really put strategy on them because, as you're seeing, what you're doing is becoming multifaceted. There's multiple moving pieces here. They have no idea when your deals are cashing out. They don't know when you're going into deals, right? And you're probably going to many and many deals. So to put that on them is just not fair. And it needs to be your 100% responsibility. And again, if the problem here is with CPAs, most of them don't do this themselves. They're just investing in stocks, bonds, mutual funds, traditional investments where they don't even get any passive losses. So, what we find is most people that come into our world, most of them need to change their CPAs because their CPAs just, quite frankly, don't understand this stuff. Sometimes it's funny. People, they want to hold on to their old CPAs, but then their CPAs say, no, you can't do this stuff. But then we tell them, just have them put it into the same tax software, which is more of the commercial version of TurboTax ran by Intuit. Everybody uses the same software. And then say, Mr. CPA, type it into the software and you tell me what's happening. And then they're like, oh, shoot, I didn't realize it works like that. Oh, you're right. Okay. But I think what you want is a CPA that is open-minded, that is already experienced in doing this time and time again, and has the confidence, if ever audited, that this is totally in the green area. If you need a referral, thewealthelevator.com/vendor, or if you're in our community, just shoot us an email. We can connect you with the folks that we use. Part of this, I think, is go through this section in the next masterclass and really understand it for yourself so you're empowered to have a conversation with your CPA. Kind of switching gears here, other tax efficiencies. Again, we talked about this earlier. Ordinary tax income is very high and you get hit up with these other taxes. Capital gains tax. So a lot of you folks are smart enough to be aware of when you've held on to things longer, there's usually two different sets of taxes on the capital gains portion. You've got long-term capital gains and shorter term capital gains, which are a little bit higher. These things kind of change over time based on who's in Congress, but generally these concepts, the percentages change, like I said, but these concepts are pretty ever present. Normally, what our CPAs or my CPA tells me is anything held less than 1 year will be categorized as a short term gain, taxed a little bit more. So, ideally, if you want to try and strategize the whole thing's a little bit longer than a year, that's usually how you can get things under the lower. Of course, that's where you need to work hand in hand with your CPA. I've seen it where the intentionality of what you're doing really matter in these cases. See a deal lasts 11 months based on the circumstances of that deal, perhaps you could have that qualify as long term. And this is again, this is that gray area where you need to have a conversation with your CPA and they need to feel comfortable on what's going on here. But it doesn't even start until you out there are empowered to drive your own ship. Unfortunately, any good CPA, they're churning out dozens and dozens, maybe even hundreds of these tax returns. They just want to do it the easy way. They don't really want to interact with you or do things that are going to put them in a little bit more of a hot spot, or they'll need to turn on their brain to do it. They just want to put in the computer and be done to the next one. So you have to hold them accountable. And again, part of this is you understanding this stuff. Oh, I'm just going to get a good CPA and put my trust in them. Do not do that. Even if you have a good CPA, especially the older ones that are more established, they have established clienteles that are more mature and they can get away with a lot, being a lot more lazier, quite frankly. I've always liked to work with established operators or vendors, but ones that aren't set in their ways, doing it the old school way. And then another thing to be aware of, we talked about depreciation recapture tax. Generally, it's a little bit lower when you recaptured it. So there's a little bit of a tax advantage there. This is more minor things that we'll get into the next tax masterclass here. But I wanted to just focus on the big picture here. Again, how does this fit in my overall high level strategy? And then again, one of the slides that I first started out with, my story, and I think this is the story and transition for most people out there going from very little alternative investments and no passive income, most importantly, right? The key tax terms here are highlighted in green. You're moving from that, you're getting killed by taxes. And most of you who are already accredited investors will probably skip over single family homes because of the high liability and just not scalable. But I just wanted to highlight this intermediate category that I went through myself, where I was building up my alternative investment portfolio. Thus, my alternative investment percentage was starting to go down. My passive income started to go up. And then moving on to the more mature, clean passive income. And if you're getting my drift, the idea is getting into more alternatives such as real estate and getting out of traditional investments slowly over time. And this is where I introduce this analogy of when you first get started, you're this gas guzzling truck. Making a lot, paying a lot of taxes. But you know what? You need investing is a capital intensive business. You need money to invest. So you're going to have to do this. But then over the years, you move more into the hybrid model. And then we want to move to the 100% electric model where you have very efficient taxes. Most of it is passive income. And also that's a lot of it is coming from very little traditional investments that create that ordinary income. And I'm not saying that everybody needs to go all in, but again, this is just my story, right? Like very early on in my late 20s, early 30s, I was 100% alternatives. I'm still on that side today, right? Because I'm a general partner and operator, but that's effectively how I got to this point where I'm at today. But you're going to have your own level of buy in. Now, this slide is extremely important to understand. This is what I call bracketology. This changes every year, usually with the pace of inflation, but I would say right now, go and Google this current year's tax brackets. What I have is the 2024 tax brackets pulled up here, but the general concepts remain the same. As most of you guys know, we have a graduated tax scheme here where the more money you make, the more money you pay in taxes. And it is based off of stepwise functions where it's not like when you go into you're making $331,000 or more, it's taxed all at 37%. But this layer is taxed at 35, this layer is taxed at 32, this layer taxed at 24. So now that we got that basic stuff all the way that most of you guys already understand, where are like the synergies to overlaying these tax strategies at? To me, if you notice the tax rates, they go up gradually. But when you go from the 24 to the 32% tax range, there's a bigger break there than a lot of these others. And again, I'm just teaching you these concepts because in future years, the tax brackets will jump around, but this concept will remain the same. Find that big break. There is usually that big break here. And that's where I draw this red line. And that's why this guy's freaked out because it was such a big jump here. Whereas these are smaller gaps. Of course, you may fall in the single filers category, or I'm going to be talking mostly from the perspective of a married couple, dual income, or two people. In these cases, once you hit 383,000, the next dollar is going to be taxed at a little bit higher tax bracket. For most of our clients, what we say is try to stay under, or I guess above this red line. And you're probably saying easier said than done, right? I make what I make. But now that we're investing in real estate and able to offset our passive income, we're able to have much more control of what our adjusted gross income is. And this is for keying in on a lot of these clickbaity articles of XYZ president is going to tax the rich. They don't really do that. Unless they completely overhaul the tax code, which I don't think is going to happen in my lifetime. But unless they overhaul the system entirely, you're paying taxes based on how much money you have, your net worth. It's based off your income, your adjusted gross income, and that's what we're looking at here. So if you're able to drive your income down, that dictates how much taxes you pay. We have this concept out there, the wealth whispers. Wealthy people quietly do a lot of these strategies that what I'm teaching today. They try to drive their income down legally through real estate using passive losses, or we'll get into later is real estate professional status as additional way to drive down your income to sharpshoot a lower tax rate, or at least modulate their income every year. And what that means is they're trying to cut down on these big spikes of income. So maybe normally you're hovering around 350, which isn't too bad, but you sell a $500,000 asset and you have a $400,000 capital gain. And that would pop you up way up here and you get killed with taxes. If that's you and you have a big capital gain coming out from a sale of an asset, or maybe you got a big bonus that year, or maybe you had a windfall, check out the other more specialized masterclass we have in the members portal. I think it's 8 ways to mitigate capital gains. If you can't find it, just shoot our team an email, but that would be more specific for your situation, which we're not going to get into today. But just an example of when big whacks of income come, which is a good thing, you modulate your income down. Another term I've come up with in past seminars is I've called this like income modulating, keeping it around the same level. Like couple of years, this happened to me, especially when I was investing in syndication deals where I had a lot of passive losses. And the idea is to build up passive losses so that when things do sell, you can offset those gains. You have it waiting. But one year, my CPA elected to drive my income down to nothing a couple of years in a row. And I was like, I'm a hoarder. That's how I got here, super frugal. And I was like, Mr. CPA, shouldn't we save these passive losses for the future? And his comment was, I see what you guys are doing and investing. I think for you, even though you're not going to get a good bang for your buck, we just use it up because I see you have so much passive losses and it's not doing anything. It's better just to capitalize it as money in your pocket, even if you are only getting 10% or half of that of the savings at these higher elevated taxes. Maybe then I catch myself, a lot of that is some of the nuances. The big thing here is that, hey, there's these tax brackets here. And when we use real estate, we use that to drive down our passive income. And this is our adjusted gross income, which is again, our ordinary income plus our passive income, net of the passive losses that we elect to use to lower our passive income. So there's a combination of the two, puts you into this chart to pay your taxes accordingly. Okay, so expanding on a couple of new concepts here, passive income on the right-hand side. Again, you can knock out your passive income with passive losses or depreciation from real estate. The long-term capital gains, we talked about that. The lower you drive your income downward, the less you pay, obviously, but also you can lower down your long-term capital gains down to even lower levels, as you can see here. And if you're making over $488,000, I don't know what year this is, but again, like these numbers change with inflation typically, and sometimes these rates change, but the concepts stay the same. You can take an additional 5% off by getting yourself under this threshold here. And I put 2002 and 2003 to show you that the rates stayed the same, but the thresholds changed, right, with the pace of inflation or maybe more. Okay, so now I'm going to introduce real estate professional status here. So again, the cool thing about passive income, other than the fact that it's cool and passive, from a tax perspective, when you make passive income through rents or syndications, you can take the depreciation or losses from that deal and other deals. The key designation to talk to your CPA about is grouping your entire investment portfolio. That's the key. I think that's what trips up a lot of folks up out there. But you cannot use the passive losses or depreciation to offset your ordinary income, right? The stuff from your job or your 1099s, unless you are able to get this real estate professional status checkbox on your taxes or sort of unlock this cheat code. The analogy I like to use is like a bow and arrow set. So in a way, like the arrows are like the passive losses, right? You need to invest to get passive losses. This is why like people who don't invest in alternate investments have no arrows to play these games. But the real estate professional status is like the bow. Now with the arrows, now you're able to shoot bow and arrows. But how do you get this bow? The bow is the real estate professional status. So again, like I'm not a CPA or tax attorney, but generally speaking, and this is where you have to go in and have a conversation with your own CPA, who's the one who ultimately, at the end of the day, who's going to be that person who checks the box on your taxes to unlock this for you, is you need to have 750 hours of active participation in your portfolio. And you need to keep a little logbook on your hours. 750 hours isn't incredibly hard to hit. And you need to have more than 50% of your time or your spouse's time. So works well. You may work a full-time job, and that's going to disqualify you off the map already. But maybe your spouse doesn't have a full-time job. Maybe they work part-time and they're able to allocate those hours. The idea is that they cannot have more than 50% of the time. Of course, there's so many permutations and commutations of it. Some CPAs are extremely liberal with this thing, but I think it's important to talk to a very flexible CPA out there. I'm not a CPA or tax attorney. You don't give any tax advice here. I'm not giving any investment advice here. But if you want to jump on that intro call that we give complimentary to new members, I can size you up with what other people are doing and maybe give you a couple ideas to talk to your tax professional at the end of the day. But yeah, there's the 50%, I think, is the automatic disqualifier for some people, right? And I would cite the Fortis case law where this guy, he was trying to get qualified for real estate professional status, had a full-time job. He should have done it some other ways, maybe a short-term rental property, or maybe have some rental properties that run and allocate hours to. But because he had a full-time job, disqualified him. But once you're able to do that, now you unlock this cheat code of now being able to drive your income down to whatever you want, assuming you have enough arrows to drive it down. And now you're seeing what I was like, wow, this is cool. This is for me, that was back in like 2017 after talking to so many people who were quietly doing this very legally. And now you realize why the rich get richer and the poor who don't even have any passive losses or real estate stay where they're at and they just pay a lot of taxes. I'm a big Marvel fan. Using the analogy of the bow and arrow set, you get a bunch of piles, and this is stored on your 8582 form. So go on your taxes when you get a time, or maybe pull it up right now and search for 8582. And that is where all your suspended passive losses or your arrows will be. If you don't have it, maybe you need a new CPA. If you don't have any real estate in your portfolio, you probably don't even have that form. But if you do have real estate, you certainly should have an 8582 form. I just say that because sometimes these CPAs like to withhold that from you. They certainly withhold all the back end calculations, which is all in the computer, to accurately get you how much passive losses you have, because this is where it gets very technical. And the CPAs are smart people, but they just put in the computer. This is all stored in the computer, all the cost bases of all the assets to come up with how much you have in terms of passive activity losses stored on your 852 form. This is extremely powerful. In the Marvel Avenger universe, everybody makes fun of Hawkeye with his bow and arrow set, but the bow and arrow is extremely powerful in our world in terms of taxes. And that's why it's one of the big parts of our trifecta, which is investing in alternatives. Alternatives gives you passive losses, especially through real estate, through the depreciation. And then it unlocks all these other tax strategies, like just driving down your adjusted gross income or simply just offsetting your passive losses if you're not a real estate professional. For high income earners making over $300,000, this stuff I think is going to be your low hanging fruit right off the bat. And this is where in these intro calls is where I'm like, yeah, for you guys, taxes is going to be your biggest thing. You may not necessarily need to go big into investing in these types of investments per se. Sometimes you don't even need to do investing to get some of the tax benefits. Again, more comics and comedic relief on poor Hawkeye. They give him a lot of crap, but in our world, this bow and arrow strategy is extremely valuable. And don't discount yourself. If you're like, yeah, my spouse doesn't want to do it, remember one of you guys has to qualify. So maybe you could be doing most of the real estate hours, even if you work your day job. And that's a conversation you need to be having with your CPA. I see way too many times people will come to the bands and they just write themselves off. I'm like, nah, yeah, we saw that real estate professional status thing. And yeah, we talked to our CPA, we can't do it. I'm like, are you serious? You need a new CPA. And this is where I don't really push things on people. I think it's better when they get it from like the ecosystem that, you have a bunch of people doing it and you learn the best practices or what people are doing. But guys, like, wake up. Like, this is something you guys need to be doing. And you guys already have some rental properties here. It's not out of this world for you guys to put this together. And it could save you several $100,000 a year in taxes. It's a no brainer, guys. Like, actually see if you can implement this. And just a little bit more information. Sometimes the question comes up, can passive losses offset dividend income? When you buy like a publicly traded stock or traditional investments, you usually don't have too much to work with. So people think that dividends are passive income because they're both passive in a way. But again, just getting into some of the nuances. This is why in the beginning I was like, don't think of it as dividend income. Think of it as passive income because from the tax code, there are different categories of income. There's dividend income, there is royalties. A lot of these things people don't typically have, right? A lot of this is just focusing on the big things that we do, which is real estate, and you get passive income from that. But under Section 469, gross income from interest, dividends, annuities, or royalties is income not treated as income from passive activity. So something, a little nuance to glean there. This means that passive losses from rental activities will generally not offset the income generated from your dividends. Long story short. But unless, of course, you qualify for real estate professional status. The way to think about it, and this took me a while to wrap my head around it, is when you have real estate professional status, in a way, now everything becomes ordinary. So ordinary losses offsets ordinary income, obviously, right? So think about it like that. Like your whole world kind of changes once you are able to check that box. But it may not make sense for a lot of you guys out there. And I think that's where having a talk with me, interact with people in our community, that's where this comes from. And then you start to learn it, and then you can go in there and have an educated conversation with a good CPA. But more than likely, I think 80% of our people change their CPAs, but so more than likely, you probably don't have a good CPA, but definitely not a good tax strategist. Some people say paying no taxes, is this ethical? You can create the narration on your own. The way I look at it is we're the ones pulling money out of our pocket to put money directly into these main street types of investments where our dollar is going directly there. Where when you're investing in traditional investments, the Wall Street land, a lot less of that gets to actual Main Street. So much of it goes to hidden fees, expenses, and all these middlemen that I think that's partially why I don't really like the traditional investment world. But we're the ones putting investments into the community, into Main Street. And that's where the way the tax code is written. It's written to reward those who contribute funds that will benefit the economy, their tax incentives in a way. Mom and dad, the IRS, they want us to put money in certain places. The reason why it's so big is that there's so many of these tax incentives. We're just being selective here on which ones we typically go into. But a lot of these things are time tested and exactly what the government wants at the end of the day. Take financial advice from people who are financially free and see what they're doing in terms of strategy. And of course, always run it through your professional team. So again, high level here, I talked a little bit about the three vehicles here, but the analogy I like to use just to sum this all up is your ordinary income to passive income mix. Gas guzzling cars, bad because it typically is synonymous with ordinary income, where the electric is passive or clean income that we can easily cancel out with depreciation, or to introduce another place we get passive losses from Section 179 losses, which are equipment losses. Again, these are the three stages of investors, three stages of the journey from a tax standpoint. You're going from the gas guzzling truck to the hybrid mode and then into the full electric mode. But what's happening over time is you've got these measures where you're slowly going from a mix of less traditional investments to more alternatives, because that is where you're getting more of the passive income from, as opposed to the ordinary income where you're going to get from your day job, but also stocks, bonds, mutual funds. That's what that stuff is going to get you. So some common use cases out there, most of you guys who are starting out are going to be in the gas guzzling truck mode, the a lot of ordinary income. You need it when you first start out, right? When your net worth is under $1 million or $2 million. I think once you hit about $2.5 million, that's the point where you really start to feel like you're hitting critical mass. Certainly at that point, you're going to feel like you're moving forward. But if you're not implementing these strategies, it's going to take forever to get even to that point. So for single people in this category, get married because you're getting killed by all these a lower tax bracket scheme. You're not going to be able to utilize the real estate professional status because more than likely you as the single person are working. Therefore, you don't have somebody else to qualify for real estate professional status. For married couples with unbalanced income, a lot of times, especially when you have kids, it makes sense for one person to spend those very precious years at home and not working. And in a lot of cases, you can implement real estate professional status and actually make more money at the end of the year net of taxes doing this than two spouses working, and also get all the additional time with your kids to see them grow up. That said, couples with similar income. So the example for B here is you got a doctor making $500,000 or greater and a stay-at-home spouse. That's actually in a very ideal situation to go down the real estate professional status. It may require you to get a short-term rental or a rental property or two, but if I can help, maybe we do the cost benefit analysis, right? Like the headaches of having a rental property and then the costs, especially if you don't live in a high price area, you could pretty much recoup that extra cost and incremental headache by tax savings in the first couple years. And then the rest is just all gravy after that. And that's where you have to do that cost benefit analysis on your own. But a lot of people, they're in marriages where both spouses make the same thing. I call this a high friction, high tax model. In some of these cases, it just makes sense for both people. You just both have to work. You both have to pay a lot of tax. This is where it's good to get around other people doing this because maybe you understand and accept the role to some extent. The analogy I use for this is like an airplane, which has two engines where you're burning a lot and you're paying a lot of taxes, but that's just how it is, right? Until you get to the destination, both engines have to burn hot. Some people say, and this is where we bring in a little bit of the community aspect. Some of the best practices here that come up is when the kids are already 10, 12, you only have 6, 7 more summers with them. And they're in school, they got their own friends. So even if you got the stay-at-home spouse and they're not really interacting with them too much, if anything, you only have those 6 or 7 summers or those handful of spring, fall breaks. It probably is better just to both spouses just make a lot more money and then also burn it on really nice vacations to capture the memories and to convert money into experiences, which is, I think, a lot of the content that we talk about once you hit that end game level, $3 to $4 million plus. That's some of the common cases here. that kind of overlays into this is again my story, right? And you may not follow this completely. I think a lot of you will just skip over the turnkey rental step, but that's the hierarchy strategy and kind of the transition into this world into paying less taxes. Now, a lot of this is drinking from a fire hose. When people come into the flume, the first 3 to 6 months is just quite frankly overwhelming. But trust me, guys, you'll get to a point where you finally wake up one day and totally get this stuff. It'll be second nature to you. And sure, the taxes code will change, but the concepts will stay similar. And some of these things here have come and gone, like land conservation easements in this example. But this is what the cool kids will do. You have a high income earner making $1.2 million AGI, which is not uncommon in our group. They do a little land conservation easements, which is a way of using donations in a leveraged way to drop their income down 30%. Now you can't really do this anymore. It's a little bit riskier, but they would do this to drop their income from 1.2 to 800,000. And then they also are implementing real estate professionals status, and they can use $600,000 of PALs that they've gotten from previous years that are banked up in their 8582 form and drop their AGI further to about $200,000. Again, what they're trying to do is modulate their AGI to around that under that $400,000 range. Maybe even under. A lot of people will focus more and being a little bit more aggressive to getting it to the $200,000 range. That's why I mention it here in this fun story. They go on a summer long vacation because they're more into the stage of life in terms of wealth building, where they realize time is more valuable than money. And part of time is experiences and the richness of life. So, but they come back and their passive income portfolio did well. And a couple of their deals cash out early in November. That happens, right? Good problems to have. And now they have $300,000 of more income and they got to recapture the depreciation. So now they thought they were good in the middle of the year at $200,000 income, but it went up to $500,000. And they're always upset at the government for paying too much taxes for way too many years until they found these types of strategies. And they're like, you know what? Screw it. We're going to pay no taxes. So they deplete their suspended passive activity loss bucket, 8582 form, and they drive it down to zero. And this is what they've done in the past. But you got to be careful. There's a strategy here, right? You can't just burn up all your passive losses because in this case, they had some exits end of the year and they reached down into your 8582 form bucket and they don't have passive losses, right? Because they burned it up. And that's not uncommon, especially when you have more aggressive people who aggressively lower their AGI and use their 8582 form. I think I personally am a little bit more conservative and I probably err on the side of not using enough of my passive losses. Like my daughter, we like to go to Fun Factory. You play the games, you get the tickets. I think I got like 1,000 tickets on my card. I probably should let her buy some cool toys with it and just burn it up. But again, I'm a hoarder in that way. And same thing with my passive losses. I have a lot of passive losses that I just haven't really used and they carry forward. And when they carry forward, the tax term, talk to your CPA, is they're suspended passive activity losses. But in this example we're talking about, these guys, what they did is they just kept using it and they exhausted it. They took it from suspended and they just used it. And once you use it, you've used it. You can't use it anymore. So right now they're looking for other ways to get passive losses. One of those ways is they may go into more real estate deals end of the year, or they may look for deals that have Section 179 equipment losses. They may just buy a $6,000 pound truck or SUV to get some quick passive losses that way. Of course, you never want to have the tax tail wag the dog, buy a stupid vehicle just for some tax benefits. It always needs to make sense. That's how these guys think. And they find, in this case, they go into a tax centric fund and they get these passive losses and they sharpshoot exactly how much they need and they bring their AGI down to $100,000 and then they go and start more vacations again, right? This is how the kind of the cool kids are doing it. I mentioned that the 8582 form several times, but this is what it looks like. Mine's is pretty long. I still don't know how the heck to read this thing. I suppose you could upload yours to ChatGPT and ask it, how much passive losses do I have? And then, of course, you email it to your CPA and ask them themselves, because that's their job, is to report back and translate things like that. But again, this 8582 form, think of it as like the cloud, right? it is the running track on how much suspended passive losses you have. And that's why, because suspended is up in the cloud, and we all talk about it in terms of clouds these days. That's why I thought it was a good way of kind of thinking about this concept. But to just round out this, and again, this may be really confusing to you. It actually is simple. It's just you have to hear this several times. But just to confirm everything, properties go up in value, but on paper, their value is going down due to depreciation from the improvement portion, not the land portion. The land portion doesn't depreciate, but the improvement portion does. So what this does is it flows to your personal W-2 income if you're under $100,000 AGI, which not a lot of folks out there are. But maybe for your guys' kids who have an AGI of under $100,000, right now you can take $25,000 of your passive losses and chop your $100,000 AGI down to 75. So that's low hanging fruit for those of you guys who have lower incomes. But for if you're above that, you age out or you doesn't qualify. You guys don't qualify for that. Like how you age out or you don't qualify to, once you make a certain amount of money, you can't do a Roth IRA in a way. So, or you need real estate professional status to use your passive activity losses to offset. What is it, folks? Yes, your ordinary income. And that's what the rep status thing is. Remember the bow and arrow. But aside from that, passive activity losses cancels out what income? Passive income, right? The key there, I think where some CPAs get tripped up is they don't group your entire portfolio. Sometimes these guys think that the passive losses from that deal only offset that deal's passive income. Not the case, folks. Get a new CPA. I think of it as your AirPod Pros work, counteracting wavelength to counteract the noise source and creates a resulting noise where you would think that this is like the passive income and then the passive losses cancels it out. And the last review is if I have real estate professional status, I can use what income to offset passive income and ordinary income? Well, you can use these passive activity losses and I will be cool and rich and wealthy. Because if you think about it, it's not what you make at the end of the day, it's what you keep. Most people who haven't gone through this last hour think that what they make is what they pay in taxes. But now you guys know the truth. It's not what you make necessarily. It's what you can drive your AGI down legally with. And these are some of the tools to do that legally. The one gotcha, again, I mentioned this before, is the recapture of the depreciation at the deal's exit. When I was transitioning from my single family homes, I believe this is like 2016 or 17, I was selling off all my properties and I had a capital gain. But the big one was depreciation recapture because I made the silly mistake of doing a 1031 exchange. I would not suggest doing 1031 exchanges to most people. I know why people do it because you got these 1031 exchange salesmen running around telling everybody it's the best thing since sliced bread. But what we do in our world is this lazy 1031 exchange is the unofficial term. More of the strategy is going to be in the members portal, which you guys should have access to if you've joined our group, joined the club. It's the 8 ways to mitigate capital gains. It's, I think, one of the first few sections in there. Goes more into details into this concept. But going back to my situation, a lot of you guys who own rental properties, you guys are going to be selling off your single family homes to cash out that equity there. But remember, you have to recapture the depreciation. But the whole idea is to first check how much you have on your 8582 form, because you might have a lot of passive losses suspended, ready to use in this manner. So again, like when I sold off those first chunk of rentals, I had a $200,000 capital gain and depreciation recapture. But what I did here was I just brought over $200,000 of suspended passive losses to offset that. And I paid no taxes, offset that transition right away. And this is what's called the lazy 1031 exchange. The last major concepts I want to cover here is this bucket theory. Now, I talked a little bit about this in the retirement section. I'm not a huge fan of retirement plans or qualified retirement plans. Again, what are qualified retirement plans, QRPs for short, which we'll refer to? We're talking about self-directed IRAs, Roth IRAs, solo 401ks, DB plans, SEPs, TSPs, all those. We're just going to refer them all to quickly as qualified retirement plans, QRPs. But my whole idea is And this is what clashes with normal thinking has us filling up the legacy bucket, which is the yellow one first, right? And I think you hear echoes of it, even if you haven't been completely brainwashed, but they teach us to put money in your retirement plans first. And it makes sense. Most people are horrible spenders, and most people will raid their savings account really easy. So that's why they say put it into your retirement plans first, because it's harder to get out. But we are all here different. We are different breed of people. And I think for folks like us, the idea is a little bit different. Where try to fill up your cash flow today bucket first with at least $15,000 to $50,000 of passive income every single month. That's a lot, but that's the goal. Create your pension fund today because you may never be able to fill that up. And I think that's what frustrates me. If you're filling up your yellow bucket first, you'll never fill up today and you'll have to work forever. You'll have to have a day job or a source of ordinary income. But this is where if you, a lot of you guys can get to a point, and yeah, it's going to take a while, right? This is not a get rich quick scheme, but if you can fill this up and concentrate on this, at some point you're going to hit a threshold, normally around $4 to $5 million net worth. Then you can start to fill up the yellow bucket. By the time, if you've been doing this for a decade or two, a lot of you folks will get to 8 figures. And that's where you fill up some the third bucket here, which is more legacy wealth, nonprofits, organizations, philanthropy, things like that. You can give money away whenever. But from a bucket three is putting it in a legally formatted nonprofit and doing it that way. But hey, let's focus on what the task at hand, which is filling up today's bucket first. And a lot of that is by investing cash. And the reason why you invest cash is you can get these passive losses that we talked about over the last hour. Whereas you can invest in these syndicated deals through a self-directed IRA, solo 401k, and you get the passive losses, but it stays insulated in those qualified retirement plans. It doesn't come to you personally for you to play these games with your taxes today. And that's the key highlight there. And that's why, especially when you're investing in real estate, to give you a lot of these passive losses, is to prioritize your cash with those investments so that those passive losses don't stay insulated in any qualified retirement plan, but come to you personally so you can use those tax benefits to help you out to pay less taxes today. We talked about this concept in the past. I'll refer to a different video and a different section here, but yeah, it's all kind of part of this wealth elevator trifecta, right? Very simple. Investing in alternatives. That's where I would send people to the syndication LPE course. Pretty heavy content section there. The tax strategies, we've got another masterclass, which should also help summarize and confirm a lot of this, what we talked about in this first half today. And then the infinite banking, make sure you take a look at the wealthelevator.com/bank for that webinar. And you're ready to get that started, just reach out to us. We can get you connected with our vendors who worked it in the past there. But we will wrap up this section.